All right, welcome to Stonk Tonk. What's
Strong.
up,
Welcome
fellas?
back to Stonk Tonk.
How y'all doing this fine Sunday?
Fucking tired.
Good.
Good, man. Oh
Tired?
man.
Tired from what, John? It's not like you have kids to take care of, you negligent monster.
That's true. That's true. My wife takes care of him. I just watch her.
Yeah,
She's
just
exhausting. Watch her. You're doing a good
watch your
job.
wife take care of those kids all day.
It is exhausting.
Yeah.
Wait until your kids can get you beers. Then it's okay.
I know. I'm just like waiting until then.
Waiting for that day. Um, I want to give you guys a quick update.
Oh,
I was I'm only $33 up on my game stonk.
oh,
Yeah, so I've made 33. I only have if I were to divest right now, I'd make $33.
total.
How do you
Say
guys?
what?
Yeah, total. Well, my what's my
Didn't you sell some
position?
off?
I did sell a few off. Yeah,
So
but
technically,
I think
you're
I'm.
you're you're
Oh
up.
yeah, no, I definitely am up, but like currently, let's see, I have 3 shares in this account, the one I'm looking at now. My average cost is 187. I think I bought another one. That's why my average cost went up. But right now it's hovering around $200. I mean, is it a good buy? Is it a bad buy?
It's a horrible buy.
I'd say it's the best.
Well, my feeling is that your current billing rate of $400 an hour, there might be a arithmetic issue going on with the time spent.
Yeah,
Yeah, yeah, but gambling is not about time spent. It's about quality time with you and your money.
and
Oh,
gambler.
okay. I
Gambler.
Wow.
Yeah. John, tell us about your dating matrix that you made for stocks.
Yeah, yeah. So I recently just read a book by Joel Greenblatt. He is a super mega rich investor from the 80s, and he wrote this like super intuitive and simple formula that basically the the only way to make money is to find really high quality companies that make a lot of money that are being sold at ridiculous prices. We can buy them at very, very low valuation prices. And so he has this little website called the Magic Formula Investing that basically takes the ROA, the return on assets. So if a company is a $100 million company with $100 million in assets, then they can produce so much more money than other companies due to a high ROA. And also their price to earnings ratio is super low. That means that their value is incredibly low. So it takes those two metrics and it produces a list of 30 or 50 different companies.
Mm-hmm.
And then
So
from
was like
there,
GameStop, AMC,
AMC
BlackBerry.
was on
Nokia.
there actually.
Wait, what?
Was it?
Well, not recently, but I've seen some other. I've
Oh,
doing some YouTube research.
Justified.
I mean, damn right it was.
Sure, but no, and doing some more research on it, I found that there are other metrics to throw in there as well to really increase your returns. One of them was momentum, which is basically, hey, have they been growing consistently over the last 12 months or 6 months or something like that? And it
Mhm.
seemed that 6 month momentum was one of the best quantitative metrics to use in conjunction with this. And so I built
Honestly,
out a.
that's. Oh, go ahead.
Oh, yeah, say what you want to say.
I was just you can say honestly, it's one of those things I look at. I look at the momentum over the
Mhm.
past like 3 and 6 months, and I look at the 5 year, and like you see stocks that like blast up like after a year, and then they crash down and go down, 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 and they come back, start coming back up, and then you like wonder what that is. But
Yeah.
honestly, it's one of those things I definitely look to personally.
So pretty much to kind of dumb it down even further, the whole idea is just to see companies on the rise, buy them, hold them for a year, and sell them off. And so if you just continually do this, you're ultimately going to find these small diamonds in the rough, get them during one of their largest growth periods, and then sell them off. So it makes a lot of sense. And if I could share my screen, I'd be happy to kind of show you. Don't know how to do that.
Wait, John, did you log in with Skype again?
Oh man, no, I logged in with AIM.
Ah,
Are these companies I should invest in?
Yeah, there it is. Share screen.
oh yeah, AOL. They're gonna be big.
So
Real.
this first screen here, this is just my charts that I made. So I have two things I'm keeping track of: what my cost basis is, what I purchase in at, and what my actual growth is. So right now it's kind of even. I'm up 0.01% of what I paid for with my few investments, but I also have a benchmark against the S&P, and I'm over up 1.1% right now. And so,
I might switch to this from my high yield checking account.
yeah. And so I just wanted to kind of like have a quick view of like all the things I've done. So like these are my holdings right now. I've got Buckle, I've got HP, and Michaels, and a few of these other companies. And obviously, a few of them ain't doing too hot. But
Michael, do you want to talk on the Michael stock?
Yeah, I do actually. This week we're coming to you from Michael's. Obviously, I'm Michael as well. There's only like a few of us in the world, but we're sponsored. Yeah. Full disclosure, I am Michael, so we are pumping the stock this week.
Yes.
It's just 100%. Bound to make a lot of money.
Yep.
And
so John, holder.
John, pretty much go back real quick. Sorry, buddy. So these stocks down. You get current unrealized gains per stock and cost basis versus unrealized. These stocks that you have here listed, these are stocks that you found using your system here?
Yep, using my magic formula. And if I go down here, like these are the 30 stocks that I had in the actual list. And I chose them based on momentum. So if I want to actually look at that list here, you can see I've got the PE ratio highlighted. So I'm always looking for a PE ratio between 5 and 15, because that's usually a really good value there. Outside of that,
PE?
Price to earnings ratio. So basically what the price of the stock is versus the earnings, the trailing 12 months.
You're not supposed to say that you don't know that. You're supposed to ask for a friend. Remember?
Yeah.
I'm asking for you.
Oh, thanks.
I obviously knew it.
Yeah. Anyone listening, whenever we ask a question, we're asking for each other. We obviously already know that.
So one key thing about the actual book itself, the little book that still beats the market, is that
How little is this book though?
It's only like 200 pages. It's actually really, really small.
It's about, I'd say, 150 pages more than the little book I'm looking
at. A lot of it was filler, but what actually is really interesting is I forgot where I was going with that because you guys totally threw me off track. But
yeah, we'll
whatever.
You're going by the PE. You're telling us between 5 and 15.
So the trailing 12 months. So
physical
because no one really knows how to understand the future or whatever could happen in the future, they base it all on the last 12 months or in the past. Like, yes, you should never kind of do 100% of your focus on what has previously happened, because previous gains will not always produce future gains, but the ratios that we're using, the metrics we're using, kind of show we only want to get a piece of that history. So if I then kind of filter by the largest momentum, you can see that these 6 stocks were some of the highest ones.
Dang, way to go, Michael.
You're welcome.
Second highest momentum.
Yep. And so the reasons why I didn't choose these other ones is just after just doing like a quick kind of Google search on them, I didn't really like some of the stories that were coming out with them, or just their PE ratio wasn't good, or there's some other metrics on that weren't really.
Their leadership wasn't Trump supporters, so you were like, I'm out of here.
Exactly. Yeah. And so ultimately, I'm just going to kind of keep track of like about 20 to 30 different stocks here. And I'm trying to make sure I'm not too focused. So I've got the sector notate here. So I got communication services. I've got industrial technology and consumers companies here, and just try
John,
and.
Did you make this?
Yeah, I made everything.
Dude, you should be a professional Google spreadsheet guy. I assume.
You should be a baseball player.
It's more of a beach ball player.
Yes. Yes. You got
I was
me.
always good at beach balling.
Yep. And so basically, I'm gonna kind of put my initial cost basis and shares and everything, and I've got everything automated, which is really, really nice. So I put my purchase. Where's my purchase date? My day purchase is right here, and I've got this calculated so that if the sell by date comes within a year, it's going to turn yellow. So if I turn this to, actually, no, I guess it's already automated, so it's not going to actually do it. But I have it highlight here to show me like, hey, I need to look at selling this holding pretty soon.
Mm-hmm.
So I've got a lot of fun little automation in this.
How did you get turned on to this book in the first place?
I randomly came across a podcast of this guy interviewing.
Stonk Tonk?
No.
Oh. Well,
no, I wouldn't trust any advice from this podcast.
I thought we were the only ones talking about the market.
Right.
There's other podcasts about the market? Wow, this is news.
I know. But, actually,
hopefully no one knows about that.
One other really fun thing I built is this awesome stock lookup thing. So you put in any stock ticker here, it'll give you all of these awesome metrics. You can see total income last 5 years in millions, net income. So if I wanted to put in GME, it'll automatically fill out all of this information and show you.
It's obviously telling me to invest.
Oh, yeah. Oh, loud and clear.
because look at the net income of the last 2 years. They were down 673 million, and the previous year 471 million. They haven't made a profit since 2018. They made $35.
No amount of facts are going to make us not like this stock. I got sour news for you, pal.
So,
did you put Tesla into the thing? I want to see what the PE ratio is on Tesla.
It's 10 kajillion.
It's got to be ridiculous. Yeah, it's 1,000. Holy shit.
1,027.
Wow.
Yeah, so, if you had 100 years going forward, Tesla will never be a value stock.
Yeah.
Have the PE ratio come into those parameters.
Yeah, wait till you're driving a Tesla on Mars, though, Dad.
What?
Wait till you're driving a Tesla on Mars, Dad.
That's true.
So actually, their 6-month momentum is pretty decent. It's 1.53. So
yeah, thanks, Daddy Musk.
They took a little bit of a hit here a few weeks ago, but they bounced right back. So
it didn't stop me from buying at the peak.
So one thing I like is I've got this little field here, this target price. This is kind of like the best valuation at the time for it, like based on 30 to 40 industry experts. They say, hey, we've done a lot of valuation, and so this is probably the price point that you want to look into getting at. So that helps me right here.
Target price is 621.
Yep. So if it
goes down
falls,
to 621,
then it's a buy.
Yeah. Dude, it was at like 570 like last week.
Yeah.
Yeah.
So I built all of this.
One.
And, Kathy Wood, I guess, recently said that she expects Tesla to hit $3,000 within like the next 5 years or something.
Yeah, that's insane. That's I don't know.
Is it though?
Yeah. Well,
the market is literal insanity, though.
Isn't Kathy Wood? Is she the lady at Schwab or is she the lady at ARK?
ARK.
Heavily invested in Tesla. In fact, all of her portfolios are being overpumped by having excessive amounts of Tesla in them. And that's why there's so much noise about ARK ETF.
Well, I mean, yes, she's very bullish on Tesla, but she also has some other really solid investments like the whole Teladoc stuff.
Yeah, she has a lot of tech stuff.
Yeah.
And financial.
John, one other stock you should put in that profile is Raymond James, RJF, because it's a value stock. It's like 17 times earnings or something.
Hey guys, I
Actually,
think
it's not
Mike
bad.
has a question. What's the difference between value stocks and growth stocks? You're welcome, Mike.
Well,
I
val-
didn't. Yeah, thank
value
you.
stocks have a low PE, a low, price to earnings ratio.
Yeah.
And, they tend to be less volatile than the growth stocks, which have high price to earnings ratio. There's a problem with value stocks, which is called a value trap. So people, this stock, because it looks so cheap, because the PE ratio is like 5 or 6 or 7. But then if you look at the history of the chart of the stock, you find out that it never makes money. That it's like dead. It just sits there at the same price for decades. The value trap.
Have you ever been stuck in a value trap?
Oh, I've bought lots of them.
Whoa, what's your play when you're stuck in a value trap?
Well, you when you buy it, you don't know it. But Raymond James is at 19 PE now, so it's slightly out of parameter. But if you look at the long chart on it, it's pretty interesting. But there's another way to do what John's doing, which is a mechanical buy-sell, which is to buy an ETF called the MDY. And what that is that's the original mid-cap stock index, MDY. And so what happens with it, when a small company it gets so successful that they grow big enough to be in the mid-cap, the index is forced to buy them with no research at all. And when a mid-cap grows so big that it becomes a large cap, they're forced to sell it with no research at all. So it's a structural, unavoidable buy-sell mechanical environment. And if you look at the profits on MDY, it's a really good yardstick. So you stick it in your portfolio, like John's portfolio, stick a little bit of MDY in there, even if you don't buy it, just stick it in there as a fake position to see how all the other things are doing. See, because it benefits from the lack of oversight and human error. And it benefits from a mechanical force buying pricing and a selling pricing.
Okay.
So I've owned MDY since 1985, and it's been pretty much the most successful portfolio. So it's slightly more volatile than the S&P 500. But the fact that it has this mechanical force buy-sell structure gives it a very successful outcome.
I mean, it sounds like the cost basis is going to eat up a lot of your gains, though, if it keeps turning over so much.
No, it doesn't. Well, basically every year it'll pick up 5 to 10% of new holdings, and it'll kick out 5 or 10% of the holdings.
So does it only reorganize or rebalance every year?
No, they constantly kick out anybody that gets to be a large cap, and they constantly buy anybody that becomes a mid cap that's a smaller company. So it's an index like the S&P 500.
Well, yeah.
So it is just the mid cap index defined by has to be, I think, a minimum 5 billion to be entered, and then somewhere in the 50 billion size it becomes a large cap, and they have to get rid of it.
So your position is that MDY is good to have as a safe way to keep money, but also a good barometer as to like what the market's doing.
Well, no, a barometer against everything else that you own. See, all of your trading, if you put $10,000 in 10 different things, and one more position, put $10,000 into MDY, and then you got a horse race, and you just see if anybody can beat MDY, because it has no research and no human interference. And if you look at the chart on it, it's kind of fucking crazy looking. It's pretty.
Yeah, it
pretty
is.
There's no
It looks like
influence at all.
Well, yeah, but it's an ETF. I mean, it's just an electronically traded fund,
Yeah.
so it has certain metrics that's just like, hey, as soon as this occurs, perform X.
Right. Yeah.
so.
So
At the beginning of COVID, March
So-
20th, it hit 229, and now it's sitting at 475. So
Yeah,
someone
it
made
was
some
one-
bank.
in the year 2000, it was 100, and now it's 470. So it's
Wow.
had a fourfold increase in 10 years, or 20 years is that? No, 2010, it was 150.
What's funny is in the financial collapse of 2008, it went from 142 to 103. So even with that major financial collapse, you wouldn't have lost a whole lot of money by
Lost like 30%.
2011. Yeah, but by 2010, you were back up. So, I mean, you think 2 years.
Right.
You still have
so
to watch out for it because the cost basis. I'm trying to find a website that'll show it, but I have to assume it's got to be crazy high because if the higher the cost basis, the higher the taxes are on it, and the higher the fund's going to earn for itself. Because if it keeps trading, then they're going to push those costs onto your actual returns.
Well,
Hey,
that only
John.
happens in mutual funds. It doesn't happen in ETFs.
What?
Only a mutual fund can tax you on embedded gains. An ETF never does that because an ETF is structured like an individual stock. So if you buy an ETF at $100 and it goes to 110 by the end of the year, you don't get any taxes on that. It's only if you sell it. See, so ETFs are more tax efficient than a mutual fund.
Mm-hmm.
A mutual fund.
Why would you ever invest in a mutual fund?
Well, they're kind of old-fashioned now.
Yeah.
I mean, try and sell you on the idea of active management. There's a portfolio manager there. He's buying and selling. He's using all these,
Buzzwords.
There we go. Expense ratio.
Synergy.
Actually, the expense ratio is really low. It's 0.23.
So Bob, you were saying that you only have to pay taxes on it if you sell it in under a year.
Right. Well, yeah.
No, that's not true.
Well, I'm just trying to. I want to clarify what he was saying.
No, whenever you sell, you're going to pay tax. But if you buy an open-end mutual fund, a regular mutual fund, they can have an internal gain of 40%, and you could be hit with half of that for taxes, because they might have traded the portfolio during the year. And you can buy a mutual fund, I swear to God, in November and pay the taxes as if you owned it for the whole year of trading. Say that's one of the pitfalls of mutual funds, is you pay other people's income taxes, especially if you buy it late in the year. So it has a tax trap embedded in it. But an ETF never does, because it's just like buying common stock. There's no tax in a common stock until you actually sell some of your shares or all of your shares.
So if you sell your shares though and you reinvest in something else, you're obviously not paying taxes on it, right?
Oh yeah, you are. Yeah.
Yeah.
That only occurs in rental real estate, that you can sell something and buy something else to neutralize your taxes. I mean, you can do offsets. If you have a stock that lost $20 and you had a stock that made $20, you can offset those.
But you can only offset up to $3,000 per tax year.
But you can use those taxes for future years.
You can offset unlimited amounts, but you can't claim more than $3,000 in losses per year.
Correct.
You can have $1 million in loss, $1 million in gain, and pay no tax if you offset
over time.
Yeah, in the period of 1 year. If you had $1 million in losses in
trade, yes, that does make sense.
And $1 million in gains in that year, you would pay nothing.
So so just one quick thing, like, so one nice thing about this strategy that I'm implementing is obviously not all of the stocks that I'm picking are going to be winners. Like Buckle right now ain't looking too good. There's
You
a few
have
of them.
so few losers.
I know, so few losers. That my plan is to sell them, sell the losers under a year from holding them, because that will then I can use that loss as a what's the word for it, JP?
Tax shield.
Gain or short-term gain?
Tax haven.
Yeah, as a short-term gain. And so I can basically say, hey, as my actual income, I actually lost money from investing in these companies. But if I actually sell after a year, then I only get taxed at capital gains, which is significantly less than what my current tax rate would be.
Yeah, that's great.
So it's 15% right now for capital gains. My actual tax rate's like 22 or 24.
Yeah, and if it was a long-term, your tax would be about half of that.
So if let's just say that I make $10,000 a year day trading, right? I'm going to hit a bigger tax rate doing those day trades than I would holding those stocks for over a year.
Yes, significantly higher.
Are these taxes factored into the market? Like, does the market react to these taxes?
No, because it's your holding.
Portfolio managers rarely pay attention to the taxable situations. They're always looking just for the profit. And, they don't, like Warren Buffett always invests long-term. So he never pays long-term, short-term gains.
Is it a year? What's the difference between short and long? Is it a year?
1 year.
1 year?
365 days.
Any transaction less than 1 year old is going to pay full ordinary income tax like you were getting a paycheck. And anything after 1 year, the taxes are going to be dramatically reduced.
Well, what is long-term capital gains? 15%?
Well, anything over 1 year becomes long-term. Now, the maximum it can get is 20%, but it's a progressive rate. It starts at 0 for like the first $5,000, and then it barely gets to 10% when you get way up there, and you have to get way up near $100,000 before it gets to 20%.
And you're talking long-term capital gains right now.
Gains are very, very low cost. So finding things that you can hold off to not sell for years is fun. Now, in an IRA account, none of that applies. You can trade the shit out of an IRA.
Yep.
And it never affects it because it's a tax-free environment. So the IRA is perfect for a trading account.
Dad, how can Perenich, who gets paid $1 over the maximum amount for an IRA, how can he get a Roth IRA?
Oh, I don't know. I'm unfamiliar with the rules on that anymore.
Yeah.
You have to go look that.
I told him to open one up for each of his children.
Yeah, I think you can do that. No, they have to have earned income.
Yeah, he was going to pay
them
for
the thing is, they have Social Security numbers. Open up an individual account for them, and because their taxes are so low that that they'll never pay tax on it. So you can open up, if you have Social Security accounts, go to Schwab and open up a Schwab account, all the kids' names, and trade the shit out of it.
Dude, Perenich, that's the play right there.
What I was gonna do is when they turn 16, like give them pay, and then get their pay and have them pay taxes on it, make them W-2 employees of my wife's LLC. Go ahead, John.
What's a great idea is to actually take the Social Security numbers, just like open up like a ton of credit cards and just like run up the debt.
Run them up.
Hey, it's free money.
Yeah. All you have to do is change the date of birth.
Yeah.
On application.
I've already done all those things. How do you think I'm so rich? How do you think I afforded this plant? Very expensive plant.
It's a nice plant.
We're already did that.
Thanks.
John, finish your questioning of John Paul. I feel like
no. Go ahead. You go.
John, what is What is your estimated yearly return using this strategy?
So reading not only the book, but also just kind of researching it a little bit more on multiple websites and obviously YouTube and things like that. The kind of average return higher than the S&P is 15 to 20%. The highest it got is 30% year over year, which is amazing.
What's like worst case scenario?
A worst case, there were a few years where it did underperform from the S&P 500, but it was 1 or 2%. And so it's just like, do I just want to throw my money in the S&P 500 and kind of get obviously market returns, which S&P has been earning what 10 to 15% year over year, which is pretty decent, but
yeah.
I want more money quicker. So this is why I'm giving it a shot. I mean, I'm only investing a lump sum of money into it and just kind of like seeing how that will happen over time. The philosophy on it is you have to hold it for at least 3 to 5 years, because you're going to find some winners, you're going to find some losers, but 3 to 5 years is when you're going to actually kind of start producing those kind of returns.
Yeah, it's good. I really like it, John.
Thanks.
Yeah, it's excellent. Excellent
So,
research.
hey, John, quick question. How do you come across the companies that you want to enter into your spreadsheet there?
So that's the website. The book itself actually built out a website saying, "Hey, here's our screener. We look through the entire S&P 500 and then some, and we look at the ROA and we look at the PE ratio. Those two ratios are the main things that we look at, and then I take that and I add a few extra metrics to it to see, because I've researched that, hey, people have said, or things have said, that this is what does even better. Like the whole momentum ratio that I found, they did a study from 1999 to 2011, and if you do the 6-month momentum through that, you get like even they said like 737% returns overall, not year over year. Wow. Which is
over 5 years.
And that's on top of what the magic formula does over that time period, which why I like that idea is because 1999 was the whole .com bubble that exploded. In 2000, I think 2002, there was a huge recession as well. Obviously 2008 recession, and then 2011 is when it kind of came back. And so it went through multiple recessions, multiple bull markets, and still outperformed just about everything.
Yeah, it's pretty cool. John, are you using the PEG ratio, the PEG?
I am not using the PEG ratio, no.
Are you familiar with it?
Not at this moment.
Okay, so what it is, it mathematically puts in your concept of choosing momentum as one of your components for decision making. Mm-hmm. So it's the price earnings ratio divided by the rate of growth.
Okay.
Called PEG, P-E-G. And you should just look it up, Google PEG, because it might be a useful tool for keeping you safe from buying what's called a value trap.
Well, I think I pretty much made that myself. I couldn't find that specific ratio. And so I found a website that gives me the stock price and PE ratio of the last 20 years or I guess 40 years. And I just choose specific dates of like, hey, on this date when I run this particular on my stock lookup, look at 6 months ago and let me know what the momentum ratio is. So I calculated myself.
Okay. All right. You might want to take a closer look at PEG because it can help those decisions too.
Yeah. But the thing is, like, even without that ratio, the returns from the book, from everything that I've read and researched, you still get better return, 30% year over year above the S&P 500. So on top of that, that's what I'm trying to do as well.
Disrupt what you're doing. Mm-hmm. A PEG ratio would just be something to look at when you're looking at the PE ratio. You want to look at the PE in relationship to the growth rate. Yeah. And it gives you one more factor of decision making. So your whole plan is excellent. So I was looking around to see where the peg shows up. Maybe Schwab has peg, but CNBC doesn't seem to have it. I know Kramer always talks about the peg ratio.
Ooh, I love Kramer.
Ooh, he's
Yeah.
the best.
Kramer's always getting pegged.
Yeah.
But yeah, I mean, I'm just throwing like a chunk of money to kind of see what happens. Like,
Yeah.
if it does start to pan out, then obviously I'm going to throw more money into it and
Yeah.
really kind of go down that route. But I'm still doing my dollar cost averaging through my other accounts as well, and just trying to see how to retire as quickly as I can.
Yeah.
Hey, John,
Right.
why the lump sum?
I had the available amount, and I don't want
How
to.
much pre-tax?
I'm throwing $10,000 into this endeavor. So basically, I'm building up a portfolio over a year. About every 2 to 3 months, I'm going to buy 5 to 7 different holdings and sell them off after a year. So I'm going to have 20 to 30 different holdings at one time, and just kind of continually roll over, make my own ETF, if you will, and try to beat the market, get as good returns as I can using the metrics that I've discussed earlier.
Now, John, are you familiar with the dogs of the Dow?
Nope.
Okay, so this is in the Dow only has 20 stocks in it. So the dogs of the Dow is a structure very similar to what you're doing. And what it is every January 1st, you put into a portfolio the very worst performing stocks in the Dow. Okay, so there's 20 industrials. You're going to take the 5 worst and put them in a portfolio. Okay, and then 12 months later, you're going to sell those and you're going to buy that year's worst performing Dow stocks. And so if you chart that against the S&P 500 or against the Dow Industrial Average, it's a very interesting chart because most of the time the dogs beat those indices.
Well,
so
yeah, diamonds in the rough, yeah.
And also they're generally low PE stocks or generally value stocks. So they're inherently a little safer than growth stocks. But if you want to just explore something, Google the dogs of the Dow and bring up a chart on them and see what it does versus the regular Dow and versus the S&P 500. So it doesn't work every year, but most years it beats them.
Yeah.
So it's the essence of contrarian investing. Buy the worst possible thing and have it next year beat the best thing.
I mean, that's exactly what Peter Lynch's kind of philosophy is like find the down in the dumps company, then an industry that's not doing shit, and invest in them because they obviously are going, and obviously do some more due diligence and see what their books look like, but they will come out screaming and become like a 10 bagger or something like that.
Is this Peter Lynch's book?
Well, I just started reading that as well, but
the Magellan Fund, the most successful mutual fund of all time.
Right.
But one of his techniques was if he liked Home Depot, what he would do is he would buy every stock in that particular business. And then he would just kick out ones that weren't working. And then just keep the one that was the winner. So he held Home Depot for 25 years or, you know, like me, I've had Home Depot since 1985.
Yeah.
I have 8,000 in Home Depot and it's worth 150,000.
Wow.
That's an old period though.
Yeah. I mean, and that's what happens. Like, I mean, that's the whole, like a lot of philosophy on these value investors is if you do it right, you will never have to sell the actual holding.
Yeah, exactly. Yeah. If you can find the real winners, you just ride them forever.
And what's great is they eventually hit a plateau and start paying you dividends.
Right, exactly. And then they pay you to stay in the game.
Yep.
Yeah, most of the low PE stocks pay dividends. Well, even Apple is like a value stock.
Well, and they used to pay dividends, and I'm just kind of like investing in them over time because they're eventually going to hit another plateau and they're going to pay dividends again. And
Well, they didn't stop paying dividends.
well, they lowered it significantly. No, I'm sorry, it was Disney. Disney, I was thinking of that. They stopped paying dividends.
Yeah, Disney is a temporary cut at Disney. Right. They'll bring it back again. So, yeah. Did you buy some Disney?
Yeah.
Yeah, it's a good buy, I think.
Mm-hmm.
You know,
I think Apple's probably a good buy right now too.
It's pretty high.
Yeah, Mike, why?
But it's dropped about 10%, and it's got a dividend.
Just because it took a dump.
Mm-hmm.
And
NASDAQ just took a shit the last month.
Yeah.
It was a rather large brown one.
Yeah.
Yeah. So I figured
I don't remember.
anything like that. Anything like Apple that has intrinsic value, I think. I mean, it's a long-term stock. Like, it's not going anywhere. So, I mean, if you look at it over 5 years, it has its dips, but like it's been steady growth. I mean, it's like looking at the same chart of MDY. It's like it obviously moves along with the market, but it doesn't fluctuate that much. I mean, and it's a dividend stock too. So
it's dropped from 145 to 120. So that's about a 15% sell-off. That's pretty big in today's market.
Yeah, and I just kept on buying more. I kept on buying more as it
paid
going down.
This 0.7, a little less than 1%. And the PE ratio is 32. But it's pretty good growth.
Hey, Dad, can I ask a question?
Yes.
So I feel like the market is insanely high right now. And you laughed the last time I did this, but why shouldn't I sell all my holdings and wait for a dip?
Because you can't predict it.
Okay, well, one of the things that's going on is the Federal Reserve is continuing to dump enormous amounts of money into the economy. Everybody just got their $14 checks. And all that cash is going to, they think, is going to continue to make this market more gasoline on the fire. So your theory is correct, but the timing is probably wrong until closer to the end of this year. So I would be thinking about selling in September, October, November.
And just
then we get out
liquidating the whole thing.
Well, no, you might have winners. You might have a Home Depot in there. You might have an Amazon in there. So I don't know what you're holding, but is it just GameStop? You have other shit.
No, I got Tesla, Apple, SPY, AMC.
Yeah.
Obviously.
Solid investments.
Those are what are called keepers. You keep those forever, except for the AMC. That's a trading stock. So Apple is a keeper forever, and SPY is a yardstick to see how your things are doing. You know, it's a reference point to see whether you're better or worse.
Hey, John Paul, I bought Roku at 131. I was on Wall Street Bets one day about almost a year ago, and a bunch of people were going on about Roku. A lot of people had some calls, and I thought, I'll just buy it and sit on it. And now it's I bought it at 131. Now it's at 346.
Fuck, that's awesome.
And it's amazing. But it's been trading sideways mostly. It went down a little bit over the last month. It went down from 468 to where it's at now. And I think a lot of people wonder this. It's like, well, do I reinvest this into something else that's moving? Do I just wait and see?
So here's the reason that I would have bought Roku. Is when I tried all of the interfaces to get on the fucking TV, the Roku format was the easiest. It was the most intuitive. So there's the winner. But what can they do next that would take them above their current? The market has realized that Roku's the best product for that niche, right? Well, what are they going to do next? Are they going to become a TV maker? Are they going to come up with something entirely new? I don't think so. I'd probably sell out of it. and diversify into 2 or 3 other fun things, because that was good instinct on that judgment, and you might have that instinct to keep going. So I would probably blow out of it because I don't see a huge future over and above the peak of that mountain. Okay. So there's another portfolio to look at. It's called MOAT, M-O-A-T. And one of the ideas that Warren Buffett uses is stocks that it's very hard to compete against them because they do something that nobody else can replicate. And MOAT is a portfolio of companies that basically are monopolistic because nobody else knows how to do what they fucking do. So there's a moat, there's a barrier to competition with these companies. So if you go to M-O-A-T, MOAT, put it in and then hit holdings, it'll spit out what's inside of it. And you'll see these very interesting companies inside MOAT that basically have a monopoly. And John, you're going to find inside of this some low PE stocks.
Mm-hmm.
I'm opening it up right now. So inside MOAT, they're not giving me the portfolio. I have to go to Schwab, so I ain't going in there. But or you could go. You're going to go to
JP's banned from Schwab. Everyone.
Yeah. Not eBay. What's the other one? Yahoo. Yahoo Finance will have it.
Mm-hmm.
So
I got it.
Inside MOAT. Can you see the whole?
They have Schwab, Wells Fargo, Bank of America, Corteva, U.S. Bank Corp, Boeing, John Wiley and Sons, Chenery Andrew. I mean, this is kind of a long list here, but
yeah.
Coca-Cola, Microsoft, McDonald's, Comcast, BlackRock.
Yeah. See, all of those have a barrier to competition. Who's the competitor to Boeing? Well, Air France,
Airbus.
Airbus. Yeah. And, that's not that much competition, So it's an interesting, John, you might find some players, some low PE stocks inside MOAT.
Yeah.
So, yeah. They're all fun ideas.
Yeah, I mean, I just started researching this stuff within the last week or so, and so I just wanted to kind of see where it would take me and things like that, and so that's why I'm just kind of doing a lump sum, and that I built this entire spreadsheet to track it and see like, hey, is it worth doing this? And if so, then I'll continue doing something like that.
Awesome. Yeah, it's amazing. Great.
Yeah.
So
hey, Dad, what's your take on the Vizio IPO? Speaking of TVs, isn't that tomorrow?
Oh, I wouldn't buy it.
No,
because the entry to competition is too easy.
Yeah,
it's like, let's start a farm and grow CBD and sell CBD. Well, now they're selling at the gas station. You can buy CBD oil at the gas station.
Hey, you're hitting a little too close to home there, JP.
Yeah, so I'm telling you that game's over.
Okay,
so,
I agree with you, but every TV I have bought in the last 5 years has been a Vizio, and the TVs that I've bought that have not been Vizio, I have fucking hated. Vizio is so easy to use. It's so damn cheap. It automatically connects to my damn phone, so all I have to do is hit like Chromecast, like boom. And it just works, and it's quality, and it looks great, and they're dirt fucking cheap.
The best low-cost producers of TV is in the world, easily.
Yeah.
But what is the growth rate? What's the profit margins in that business? Is so razor thin.
Yeah, well, they're saying that they're going to create their own streaming network or something.
And who isn't?
Yeah, exactly.
Yeah.
So.
Yeah, so are we. We're doing one.
Yeah, we're making our own. You'll be the next Crackle, or what was it? Quippy? Was that one that failed?
Yeah.
Quippy.
Well, Vizio is probably made in Korea or China, and the next thing that's going to happen is a company from Vietnam is going to compete with them because their labor force is even cheaper.
All right, 4 minutes.
Hey.
Any final questions, thoughts?
Hey, John, I think it would be cool to kind of maybe just do one of these episodes and just have you kind of like slower like walk people through, like, because you have a lot of like complex like things that you're looking at here. I'm pretty impressed with like the overall process that you come up with, but
Yeah.
I think we just kind of skimmed over it, but I think it's really good.
Yeah, no, I'm happy to share my Google spreadsheet as well. And since
Cool.
JP mentioned MDY, I'm building out a MDY metric as well to kind of compare my portfolio versus that as
Nice.
well.
John,
Nice.
what's your when are you hoping to retire with this new plan?
I have no idea. I
Next
mean, if I could invest more money into it, I'd have a better idea. This is just kind of like, hey, I kind of have the cash, so let's just give it a shot. And if it works out, awesome. But if I lose it, it's not the end of the world. So I'm just trying to test this out, see if it's a decent theory, and kind of ride with that.
How long is the test going to be until you know if it's good or not?
35 years.
So you're only doing 10 Gs over 35 years then? Did I understand that correctly?
That's what I'm starting out with. If I kind of like see based on the charts that I've built out, and if it's actually doing better than the S&P 500, then yeah, or the MDY, then I'm gonna kind of throw more money into it and see what that looks like. But if I'm getting 20% returns, that's not bad.
So how long does it take to double your money at 20% return compound?
2.5 years.
I thought
It's called the rule of 72.
right.
You divide 20 into 72, and it's 3.5 years.
3.5 years.
Yeah.
That's what I said.
Oh,
That's
you're
what I
right.
said.
I'm
Yeah.
sorry.
No, I'm just kidding. I didn't say that.
Oh, did you say 2.5 years?
Yeah.
Oh, okay.
Math.
Cool.
So yeah, that's what I'm trying to do. So if I could
This
get
episode of Stonk Tonk is sponsored by Mathnasium for all your math needs.
pretty much
That's not where we went.
My retirement goal is to get about 2.5 million, and once I have that, I'm gonna kind of push that more towards a dividend holding portfolio, and then just ride that out because that'll get me from 80 to 100K a year.
John, what are you going to do when
Well,
you
what I
retire?
would say,
Just jerk off constantly.
and play video games. Let's be honest. You're gonna fire up Diablo.
Hey, Diablo 2 is being remade. It's being remastered.
Of
course it is.
Of course it is. But I mean, honestly,
But
I don't know. I love my 3D printing. I love just these little hobbies and just hang out, do whatever the fuck I want. That's what I want to do. I don't want to fucking work.
I think if I didn't have to work, I would probably still be day trading.
Nah, I'm not smart enough for that.
Dad, when did you know, or what was your like retirement goal? Like when were you aiming to retire, and when did you know you could retire?
Well, I was aiming to retire. I wanted to retire when I was 50, when I was John's age. And I had the same goals, but it didn't happen until I was 55.
Loser.
Oh man, what a chump.
Yeah. So that was, but it was a lot of luck. I was over, my portfolio was overweighted heavily in Raymond James stock because they were giving it to me for free every year. And we were allowed to buy it for 85 cents on the dollar. Mm-hmm. So there was 15% gain every time you bought it. And so I was heavily overweighted, and I saw the growth of the company was growing at 20% a year. The stock was going up at 20% a year from 1985 for about 20 years. It went up about 20% a year, and then it had to kind of level off after the 2000 debacle. And now it's rolling on again. but it's not. I was just stuck there for tax reasons. I couldn't get out of it. You know, I was working and my tax bracket was high, so I couldn't afford to sell any of it. So I sort of accidentally had a really large position in one thing. So a way to retire a little early is sometimes you have to gamble and put a lot of money in 1 or 2 or 3 positions. You know, a long run coming.
That's what Chris and I are doing with AMC and GameStop. We're gambling.
Yeah.
2 positions.
I mean, I don't know.
Our retirement hinges on those stocks. I'm very bullish.
If one of them hits $1,000, I'll be sitting pretty.
That's it.
Will you?
Listen, GameStop's going to go to 400,000. Mark my word, I said it. Mic drop.
Right.
Come down there, Kathy.
Bankrupt the entire market.
Retired to run GameStop.
Exactly. All right, well, we've gone over time, so we're going to have to end this delightful jaunt down Stonk Tonk Alley.
Yes.
Thanks so much for doing this, you guys. Y'all have a great rest of your night.
Good weekend. Keep trading. Keep making that paper.
Making
That's
that
it.
paper.
Make
Make it rain.
All right. Good night.
It rain. All right. Bye, guys. Love you.
Yeah.
Good night, y'all.